Welcome back. Well, we'd like to continue our discussion in the housing market and look at some of the specific economic numbers because they do provide a wealth of information. Starting off with the Housing Affordability Index. This is published by the Federal Reserve Bank of St. Louis and the National Association of Realtors. And what it does is it measures the degree to which a typical family can afford the monthly mortgage payments on a typical family home for a fixed mortgage. Now, a value of 100 means a family with a median income has exactly enough to qualify for the mortgage on a median price home. If the index is above the median income, it indicates a family earning the median income has more than enough to qualify for the mortgage on a median price home, assuming a 20% down payment. Obviously, if the number is less than 100, it means they cannot afford the median price home. Now, specifically, we're going to look at the correlation between the Affordability Index and the XHB. The XHB is the S&P 500 ETF, which represents the home builders. Those stocks, those companies that go out and develop homes, build single-family homes and entire developments. Now, specifically what we're going to look at is here. The Affordability Index is shown in the blue, and the XHB, the Home Builder Index, is shown in orange. And we can see, going back around 13 months, starting November of 2021, we can see both lines are very much to the upside. Now, this is a 96% correlation, a very, very strong correlation. A 100% correlation would show a perfect relationship. When two stocks have a 100% correlation, when one stock goes up by 1 point, the other goes up by another point as well. So we have a very, very strong connection between the two. And we basically see here that as the median family, their ability to afford a median price home falls below 100, which it did so. We're looking back to April of this year. We can see also the Home Builder Index fell by the same extent and has followed a very, very similar pattern. Now, again, this is very important because the home builder stocks move in anticipation not only of higher or lower interest rates, but really the overall economy and whether the average family can afford a median price home. We should also make note, and we've discussed in some of our other videos discussing the inverted bond yield curve, that the inverted bond yield curve really started to emerge around April, May, June of this past year. That's when the affordability index dropped below 100, that magic affordability level. So it's very interesting to see. That's also when the Federal Reserve really embarked on a very, very aggressive tightening cycle, rising interest rates more than they ever have, at least in the past 30 years or so. So that's those two phenomena really kind of coincide with this affordability index falling below 100. I don't know if there's a connection between that or just a happy coincidence, but the 96% correlation really does show a very strong connection between the ability for the average family in this country to be able to afford an average price home. And again, when that level falls below 100, that does not does not bode well for the overall economic conditions. We hope this has been helpful. We look forward to seeing you back soon.